Well, welcome back, everyone. Another exciting day in markets. Let's get right into it. We maintained the uptrend channel from October 2022. We broken below the bottom of the box. That happened a couple of weeks ago, solidified last week. Let's zoom into the box and get a sense of where this market is likely to go. Below the bottom of the box on Friday, March the 6th, that intense reversal that we were looking for, a deeper low on Sunday night on the 8th, and then a reversal back up on the 9th. We got that. The reversal was a little stronger than I expected. We were expecting markets to come back down into the back end of last week. We got that happening. We looked for a move that would take us lower when I was commenting to Wealth Charters and Active Trade Room members midday on Friday the 13th. Looked for that lower low, got it, and we were looking for an oversold bounce to start taking place in the market thereon after, and that's effectively what has now happened. An oversold bounce has taken us up into this channel, and we're trying to push up through the top end of the channel. However, risks still remain to the downside. If you take a look at the technical signals, in general, we are still configured to move lower. And of course, this is supported by oil having come up over 45% from February the 27th to where we are right now, stuck underneath a resistive structure, namely a retracement line around 96 bucks and 37 pennies. Above there, it opens the door for a continued rise on oil, and oil and the markets are very inversely correlated, which would mean down on the markets. However, if oil finds its way down below 92.62, the door does open for a market bounce and a pummeling down on oil into the high $80 range, the $89 to $88 range. Again, above 96.37, downside risks for the market grow, and we're certainly closer to that number as we speak right now, as I record this video into the end of this trading session on Tuesday, March the 17th. So we know that oil is posing downside risks, but are they offset by some of the other things that the market's tugged around by, namely the dollar and the euro? The euro is up again on the day, but it's up very modestly. It's not up significantly enough to suggest that it's going to add a significant tailwind to equities. Nonetheless, we do have the equity market rising off of lows. Let's go and take a look at the technical layout on this. So you're looking at the S&P E-minis over here, and you can see very clearly over here on a daily chart, which is what we've been really tracking towards since the beginning of February, where we had that beautiful pre-trade conditioning, where we have at least 3 signals not separated by more than 6 bars, and you're left with a signal. In this case, there were 4, and price action went down below the MSR channel. The blue line was sloping down. Now, we didn't just go down the hatch. We did make a lower low the next day, but we popped up and we waited for Nvidia's earnings, where the double red dots on the triple S tool went to a single, but back down the hatch we went as expected. 2 closes below the MSR channel. As you hear Rob say, that's a directional shift, and down the hatch we went. Is this oversold bounce strong enough to repair things? Well, oil is still telling us that the geopolitical risks are high. The private credit crisis risks are still high. We can see that in rates markets. And when we take a look at the multi-time frame view with the triple S indicator, the daily chart gives us a signal out for a week or two. The 4-hour chart is about 3 to 5 days. The hourly chart, 3 to 6 hours. The 5-minute chart, 20 to 90 minutes. So one of these 4 charts is not like the other in terms of signal. That's the hourly chart. The hourly chart is weaker. It's come down below its speed lines, but we're in a sell signal state on a daily, a 4-hour, a 5-minute, and down to a 1-minute chart at this stage. So the odds still lean to downside risk. If we do see price action get back up and above roughly 67.40 to 67.50, we then have the opportunity to rise and come back up to do what? Well, to test the underbelly of the box that we have broken down below. The underbelly of the box is sitting at 67.80. So at this stage, without that happening, the technical signals do suggest more down, and we've got this amazing pattern that's been playing out really since late morning using the triple S tool on the 5-minute chart. We've had pre-trade conditioning be in place all the way up until about 2:20 p.m. It started right over there, and we had oscillating signals. We were trapped in the MSR channel, but we've been left with a down signal, and the double red dots persist on the 5-minute triple S bars, which imply more downside risk versus not, and potentially a lower low on the day in the cash hour session. However, I want to make provision for if we come back up above 67.30, 67.40, the odds do change to the other side. Currently, the market is slated to more likely move down. And I used the pre-trade conditioning, the chop and the slop in the sideways market action to trade again. I traded both the ES and the NASDAQ in front of active Trader Room members and wealth charters alike, grossing over $1,100 to add to my tally from the tail end of last week, which is now very close or just shy of $12,000. So I was able to trade 4 different accounts individually, no trade copier, low contract size, and was able to get out again today using these incredibly powerful tools like the Champion Trend Pack and the Triple S indicator combined together. I'm going to be sharing a lot more insight with you on this stuff as we move through the week. Where I want to leave you is tomorrow is Fed Day. Do you think that Jay Powell is going to come out and be a dove for his swan song as he transitions that role over to Warsh? Or are we going to see him toe the same line, which the market may not like? He's caught in between a rock and a hard place. We know that oil has moved up so dramatically, so fast, which makes it very hard to adjust to. And that can be an inflationary spiker, if you will, which makes it very unlikely from my perspective that he does do any sort of hinting at rate cuts or even more liquidity measures unless the crisis becomes a really deep crisis. And that usually doesn't happen until we're about 15% or more down from the highs. I'm still looking for this market to play out a correction and come back down into this territory. But of course, I'm going to trade what I see, not necessarily what I think. What I think is a great planning stance. What I see is the Triple S is in a sell signal state. I'd rather be in the short side of the trade until we're back above the MSR channel and looking for the market to continue moving down as we move towards the end of the day. Again, above 67.30, 67.40, my view changes. If I see that, I'd rather be on the long side into the end of the day. I hope that this video finds you well and that you enjoyed the insights from it. More coming up in the days ahead. Have an incredible rest of your day today, and thank you for watching.